Hey there, John.Hunter with New American Funding coming to you this week with a question I had from a past client this last week. It is, why aren't ARMs more popular? So let's talk about it. It's a question I do get often, with rates being as high as they are, is, well, why don't I just do an ARM? It'd be a lower rate, right? That's the way it's supposed to work. And you would be right. That is the way it's supposed to work. But conventional wisdom is out the window right now on a lot of fronts when it comes to lending, and this is no different. So we're finding that ARM pricing very often, if it's even available, is the same or higher than a fixed rate. It makes zero sense if you look at it from a traditional point of view, which is if you're willing to take that higher risk of having an adjustable rate, you get a slightly lower rate in exchange because it's not fixed long term. But that's not the case right now. And there's three reasons why. A little trifecta going on right here that is not good for ARMs. So the main reason, or a big reason, is that the underwriting criteria after the crash that occurred vilified ARMs. They deemed them high risk loans. So there is just way fewer lenders that are even offering them. VA and FHA used to have a wonderful ARM product, a 3-1 and a 5-1 ARM product that was amazing. It was a great loan. Offered a way better rate, qualifying at a much lower rate. So people qualified for more. It just was a good loan. That went away. It's not offered anymore. And the normal conventional ARM products are gone. The ones that are left are higher credit score requirements, lower loan to value, lower debt to income ratio. Basically, they're cherry picking. So of the loan products that are out there, there just are a lot fewer of them, and the ones that are stricter. So that is a huge factor on limiting the availability of ARMs for most clients, right? The debt to income ratio is a big one, right? So if I came to you and you said, okay, you qualify for a $500,000 house on a fixed rate, but it's a 425 on an ARM, right? You wouldn't think that's the case, but because of the underwriting criteria, that often is the case. So ARMs are out right then just because of that. The second reason of our little trifecta here is probably the biggest one, and it's the cost of funds, okay? So not to overcomplicate this, but when they base an ARM pricing, they look at, like, say, the 2-year treasury versus 5-year versus 10-year treasury, okay? And in a normal market, a 2-year treasury is lower priced than a 5-year, and a 5-year is lower than a 10-year. 10-year pays the best because, or 10 or a 30-year pays the best because it's a longer commitment, right? And the short-term commitments pay the least, right? That's a normal market. Well, right now we're in what's called an inverted yield curve, which the 2-year treasury is paying significantly better than the 10-year or even the 30-year. That's not normal. Actually, it's an indicator that every time it's ever happened in the past and in history, it is followed by a recession within 18 months. We've had an inverted yield curve for the better part of a year, right? A recession is coming. If that doesn't tell you it, I don't know what else will. That indicator has never been wrong, and we are very inverted right now. Now, because of that inversion, the ARM prices are priced off of the shorter term treasuries, not the longer term treasuries. Well, they're higher. So ARM pricing, the base ARM pricing, is coming off of this cost of funds, what the banks pay for the money, which is higher on the short term than it is on the long term. So ARM pricing right there, just because of that, is higher. So the banks are paying more for this money. They can't give it to you at a discount because they're not getting it at a discount. There's no money in it. Plus, on top of that, look at it this way from a bank's point of view, any loan they do today is going to pay off in the next 24 months because rates are going to drop and people are going to refinance. So if you're paying top dollar for the money and you know that loan's not going to be on your books very long, you're not going to make much money to begin with, if any, why would you want to do it? Well, the banks don't. Now, that third piece, right, and it's also equally important piece, is what they call liquidity. Now, most ARM products that are out there are not agency products. They're not Fannie Mae, Freddie Mac. A lot of times you'll see it on jumbo loans, portfolio type loans. The banks are lending their own money, right? So they take in deposits from people checking savings accounts, and then they lend out the money and they make a margin, they make a difference, right? That's how the banks make money. Well, the Fed has come in, and I'm sure you've heard this on the news, banks having issues and banks having problems. Some banks, one in California, I believe, the Silicon Valley Bank, failed, right? Well, that's very bad. We don't want to have to pay for that bailout. So what the Fed has done is they've come into the banks and they have said your reserve requirement, which means the money you have to have on hand, cash wise, they are not allowed to lend, needs to go up. So they increased the reserve cap for all of these banks, basically telling them stop lending. Okay. So if you're a bank and you only have X amount of dollars to lend, right? And you have all of these other criteria, your cost of funds, and then the stricter underwriting guidelines, basically you have no market where to sell these loans, you're not going to do them. So that liquidity is a huge issue. The banks are not lending as aggressively as they once did because they can't. They're required to have this increased reserve requirement. So you have this little trifecta going. You have a stricter underwriting guidelines. You have liquidity issues. Banks are being told not to lend. And on top of it, you also have the cost of funds. So the ARMs that are out there are priced at or above the fixed rates, and they're harder to get. So there's your answer. That is why ARMs are not more popular. Now, as our market normalizes and we see the inversion go back to normal, and we see money coming back in and then lending pick up, we could see ARMs coming back a little bit and being a little bit more competitive. I don't see that happening anytime soon. I think the liquidity issue is one that we're going to be stuck with for a little while. And the cost of funds is not going to go away for probably at least 24 months. So I don't think ARMs are going to be the answer. Hopefully we can come up with something that is. But until then, we're going to have to look elsewhere. So hopefully that answers your question. I would love to hear your input. If you have a take on it, if you have insight on adjustable rate mortgages, or maybe something I've missed, I would love to hear comments. I have a calendar down there. If you have any questions about your situation, and if you wanted to talk, run a scenario past me or plan for the future, buying a home, whether using an ARM or another product, a fixed rate, feel free to reach out. I'd love to hear from you. So John.Hunter, I'm your mortgage guy. Would love to chat with you about it. Have a wonderful weekend, and go Cougs. Talk to you soon. Bye-bye.